questions on this? So no class next week, no Zoom meeting. Okay, let me go to today's handout. And my reason for switching the chapter 11 and chapter 10 around, chapter 11 is on kind of the nuts and bolts of doing the depreciation expense. So I wanted to do that first because chapter 10 actually kind of goes into some of the detail of it. And I think that it is, just for myself, I think it's better that you do it, you know, you do the nuts and bolts stuff first, but you know, it probably doesn't matter too much. Okay. So let's go over the stuff that we're going to cover for chapter 11. Okay, tangible assets, usually property, plant, and equipment. Never current assets. Current assets are not going to be depreciated. So tangible asset, their depreciation expense. Yeah, so for instance, my inventory is never depreciated. It's an allocation of a tangible asset over its life. So that's what it is. We're not trying to find the value. You know, we're just trying to allocate the usefulness over its life. Now, it could be that it is make strange happen. You know what happened? You know, like I know I'll tell you because I think we're going to it. I think they're going to do away with Zoom meetings. I don't know if they told you guys about that, but we're going to the Microsoft Office, the Teams thing, which I don't know why we're doing it, but anyway, we are. And it did something to my camera. My camera stopped working on the computer for a while. But anyway, so in the future, I'm not sure when this takes place, but we're going to be switching over to Office Teams. And like I say, I'm not sure when that's coming, but anyway, so let me go back to where I'm 6 minutes in. I haven't told you guys anything. All right. Allocation is supposed to be systematic and rational. That's for all allocations, whether it's inventory or depreciation or anything else that's allocated. Systematic just means repeatable. Rational just means it makes sense. So systematic, repeatable with the same results. So systematic just means that you'll come up with the same answer I come up with. We use the same method. Irrational makes sense. Okay. So these are the two accounts that we use for recording the depreciation. Depreciation expense and accumulated depreciation. And so that's what the journal entry looks like. Okay, now I'm going to show you something very morbid. You can remember the journal entry for depreciation. It's always the same, and you remember it by the acronym DEAD, which I know is terrible. I wish there was a different one. I wish it was live or something like that. But anyway, at the end of its life, it's dead. So DE and then AD. It's morbid, but if you remember it, I guess it's fine. So yeah, depreciation, expense, and accumulated depreciation. All right, now on the balance sheet, we have whatever the asset is at cost is listed, and then we subtract out the accumulated depreciation to get the net value of the equipment. Sometimes you'll see a lot of companies will just show net equipment, and you have to go to the footnotes. But this initial cost does not change. It stays at whatever you paid for it. Only the accumulated depreciation changes. I think we may have talked about that, didn't we? I don't know. All right. Let's go to intangibles. We're not going to do a lot with intangibles, but intangibles, instead of having depreciation expense, they have what they call amortization expense. And it's different than for tangible assets in that it just decreases whatever intangible you're talking about. It decreases it. And there's a good reason for that. The reason being is that property, plant, and equipment is usually stuff that you use and you'll replace. Intangible assets are virtually always unique. They have to be, or else they're not. For instance, a patent. You can't have a patent that's just like another patent, then it wouldn't be a patent. A patent is a new way of doing something. Same with copyright. If someone's already copyrighted it. You only have so long to have it trademarks and stuff. Goodwill is when you buy another company and you pay extra for it. Customer list. This is a big one. If you buy out actually, if you go into accounting, if you buy out a CPA firm, what you're really buying is their list of clients. And the same thing if you do like something like landscaping, if you have a landscaping business, what do you buy? They might have a few mowers or a few $100s, but it's a list of customers. That's what you're really buying. So customer lists can be virtually, close to 100% of what the value of a business is. You buy a CPA firm, you buy out a CPA firm, you're buying that client list. They may have some computers, maybe, a couple $1,000s worth of computers, but what you're really buying is that customer list. So customer lists are actually pretty big. They can be anyways. And same thing with franchises. They're all different. They're not going to be you're not going to buy it's not like buying a drill press and it wears out. You got to buy another drill press. These are unique. And because they're unique, we don't have to worry about, what it costs to reorder them. For instance, up here, you have equipment about 25,000. When this thing gets near the end of its life, you're going to say, okay, it's probably somewhere around 25,000 or around that area. We're going to have to pay out for a new one. There is no new one. There is no, same thing on here. So here's how this would be shown. It would take it right out of the intangible. Here's the intangible if it's a patent. Take it right out of the patent. And on the balance sheet, you would just show the intangible. That's it. No accumulated or anything. Okay. Let's do a little of the nitty-gritty stuff. Let's go down to the stuff for today. And I know you guys have had this before, but we're going to go through these and kind of go through how we calculate these. So first method we're going to use is a straight line. And the straight line assumes that you write off everything the same every year. Okay, so let's see how this works. We purchased a van for $33,000, delivery van. Let's make that yellow, easier to see. It will last we estimate it'll last for 5 years. It's estimated that it will be worth $3,000 at the end of 5 years, and usually these coincide that we plan on keeping it 5 years, and that it will, after 5 years, it'll be worth $3,000. Calculate the annual, blah, 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 each of the following methods. Now, we're going to have 3 different methods. Straight line, go on the other page, double declining balance, and units of production. And so these are the 3 methods we're going to use, and it's up to the company which one they want to use. All right, let's take a look here. So straight line. For straight line, we say, okay, how much is this thing going to decrease in value over its life? It's going to go from 33,000 down to 3,000. So it's going to be decreasing by what, 30,000? So I'm going to put this in here. This will be cost 33,000 minus I'm going to call this the residual value. Or salvage value could be called it. Can we use it anywhere else here? Yeah. Residual value, salvage value, terminal value. There's all kinds of, I'll say residual value. So this is how much it's going to decrease. And it's going to do that over, oops, nope. Here we go. It's going to do that over 5 years. So we're going to take this and divide it by 5 years. Okay, so this will look like this. Let's see, 33,000 minus 3,000 is 30,000. You guys are probably already done with this, aren't you? Divided by 5 years. And this is going to equal, I think it's 6,000 a year. Thank for Mr. Calculator. Yep, $6,000 per year. Okay. So our cost on this thing was 33,000. We are going to expense 6,000 every year. Can you see those?
Yes.
Okay. Now the first year, the accumulated depreciation is going to be the same. It's going to be 6,000. And the carry value will be 33,000. It's going to be, oops, this minus the accumulated depreciation. This is the total depreciation to date. The debit and the credit, this is going to be the journal entry. So let's go back up here to the journal entry. Nope, not that one. This one. Here's the journal entry. Let me clean it up so we don't need. So here's the journal entry. So the depreciation expense will be the debit, the accumulated. This is going to be for 6,000. This is what the journal entry would look like for down there. It would look like this, 6 and 6. And now we get the carry value. It's going to be whatever the cost of this equipment is minus the accumulated depreciation. So this is be the new equipment, net equipment. This will be the carry value. Also sometimes called the book value. For taxes, it's called the basis. I don't know if you need that. I'll put it in. Why not? And for taxes, it's not really a value. It's it's there's different things that go into it. So whenever you see carry value, book value, net value, those are all the same things. Oops. Okay, so the cost of the asset minus the accumulated depreciation is going to give us the carry value. Here. 33 minus 6,000 is 27,000. So they'll at the end of year one, so this is on 1/1 of the year. And this is on oops, let's see here. Like on 12/31. I'm assuming they have a year end at 12/31. Okay. Now, here's where it gets a little bit tricky. The cost will always be the same. In fact, I'm going to go right ahead and put those in down here. This will always be the same. And I know it's tempting to say, oh, this must come over here. It actually doesn't. It kind of just the method that we use. What's going to happen is this. In the second year, we're going to depreciate another 6,000. Now, the accumulated depreciation is going to keep just adding up. This is not going to be closed out. It's going to keep going. So the accumulated depreciation will have all of the depreciation to date will be in that account. So it'll look like this. 6,000 plus 6,000. So this will be 12,000. It's just going to keep adding up. We're going to add 6,000 to the accumulated depreciation every year. And when we take the 33,000 in year 2028, we're going to subtract out 12,000 out of it. Does that make sense? Maybe a better way for me to do this. Hmm. Was that 21,000? So this accumulated depreciation, these two go hand in hand. This is accumulated depreciation is actually a contra asset. It goes against whatever the asset is. What is this thing anyways? A van. And we're just going to keep going like this. The straight line method is going to be the same every year. So 6,000 plus 6,000 plus 6,000 is 18,000. So it'll be kind of like if you just keep adding 6,000 onto it, for this method, it's all the same. So this is all. Yeah, come on. I know, I'll do it like this. There you go. So 33,000 minus 18,000 is 15,000 maybe. All right, I'm not going to do any more of those. Okay. You know what I notice when I'm doing something like wacky is that is actually going to go into the editing and I'm looking through the thing when you're like, oh my gosh, did I actually do that? What a mess. Okay, so it's 24,000. 33,000 minus 24,000 is 9,000. And lastly, oops, 33,000 minus 30,000 is equal to 3,000. And by the way, oops, oh, I messed that up. The 30,000 here, this is actually what they call the depreciable amount. Uh, and that's what they're talking about. It's going to depreciate by 30,000. That's what this is. And this is the residual. Eh, this is what we expect it'll be at the end of its life for those two. So we're going to depreciate 30,000 of this thing over the 5 years, which is what we kind of knew. And it's going to go down to value, residual value, terminal value, salvage value, whatever you want to call it, of 3,000 at the end of its life. If we look into the crystal ball correctly, that's what it'll end up being. Anything that's close to that, you'll be probably happy with. And the question is, well, where do you come up with these numbers? Where do you come up with the 5 year? What you pay for is what you pay for it. But how do you come up with the 3,000? How do you come up with the 5 years? How would you figure those out? Let's say that you've been in business a while. How would you figure it out? So let's say you've been in business for 24 years. How would you probably come up with those estimates? You can put it in chat if you want. And if your company's getting audited, they'll definitely ask you, where'd you come up with those? So it's 5 years. Where'd you get that from? Probably what? Anyone? Probably what you did in the past. Okay, how much, okay, in the past, maybe the delivery, you could sell it for around 10% or something like that. You go, okay, we'll round it off to 3,000. And maybe they'll last about 5 years, some 4, some 6, whatever. You'll see what you have. If you have a past, you can go past. You can also look and see what other, ask, even salespeople, at what age do most people buy a new one? They might, say, oh, like 5 years-ish or something like that. So, okay, double declining method. I am going to show this the way the book shows it. So this one is a little bit tricky. Double declining balance. I'm going to go ahead and just show it to you, and then I'll explain how and why we use it in a second. But the first thing we got to do is find what they call the percentage of it. And we do that by this. There's a 5-year life. And that's really all we need to get the percentage. I'll show you why. This is the calculation for it. So the percentage for this one is going to equal 1 over 5 years. Oops. So however many years there are, you just take 1 over it. It's kind of like the straight line method a little bit, but it doesn't do anything with the residual value. Okay, so 1 over 5 years. And then we're going to double it. So 1 over 5, 1 divided by 5 times 2. 1 divided by 5 times 2. I think it's 0.4, but let me. Yeah. So this equals 40%, or 0.04, or 40%, whatever one you want to use. These are exactly the same. So this is what we're going to use for when we do our calculations, and I'll show you how we do it now. Let's see. Okay, and you know what I should have done? I should have copied these down, but I was typing. Yeah, actually, no, I was typing them in. It's probably better. The 2027, we start out with the entire amount, the entire cost of 33,000. And what this is this is actually the carry value or the net value. And on the first day of the year, when we first buy it, this is the carry value. On 1/1, this will be the carry value. We're going to multiply it by our percentage. I'm just going to use the 0.40. Either one should get you the same place. Oh, okay. equals 12,200. No, not 12,000, 13,200. So this will be our depreciation expense. So 2027, this will be our depreciation expense. So I'm going to come down here and start filling this thing in. This will be the same we did before. This will be 33,000. The depreciation expense will be 13,200. In the first year, the accumulated depreciation expense will be the same thing. The carry value will be 33,000 minus 13,200. You get 19,800. And that's what we're going to do over here. We're going to kind of, as we go down the list here, minus 13,200. We're going to start out with our new balance on a new carry value, I should say, of 19,800. So 2028, our new balance will be 19,200. And we started all, ooh, that's not right. Don't put that in, 19,200. So this will be our new balance. Actually, maybe I'll do that over here.
19,800.
Oh, I'm sorry. Thank you. Yes. And we're going to start the whole thing again. Oops. Times yep. Oops. Seven thousand nine twenty. Oops. How do we do that? Okay. All right. So 7920. So this will be our depreciation expense in the next year. I'm going to do something just to clean this up. These are always going to be the same. Okay. So the second year we're going to have 7,920. And our accumulated would be $21,120. This is 11,000. Yeah. If we come over here, if we subtract out this 7920, it should come out to be that same number. It's more confusing. So let's start out 20, 29. Now, at some point, we're going to have to switch over to the straight line method, and I'll get to that. Possibly. Let's see. So this is 19,000. 11,880. So this is going to be our third year. Oop. Okay, so 47. Plus 21,120. I think somewhere around here we have to start thinking about the straight line method coming into play. If you guys are good at playing with numbers, which you probably are because you're in accounting, you'll notice that if we keep going on like this, it's just going to keep going on forever. Right? I mean, 40%, 40%, but it's just gonna keep going down for 40% of it, whatever. It'll go on for, I don't know, tens of years. And this thing's only gonna last for 5. So at some point, we got to kind of start thinking about what would the straight line method be from this point. Usually you can get in 2 or 3 years into it before you have to worry about this. But the idea is, at some point, the straight line method is going to give you more of a depreciation than the what we're doing with the formula here. So I'm just going to check on this one just to give us a point. Now remember, the carry value is this. There's still 3,000 of salvage value in there. So we're going to still depreciate about 4,128. And we'll keep that in mind when we go to this next one. Oh, darn it. Oh, we goofed that one up. Hold on. So this is how much we still have left to depreciate. We're gonna go through and do this, go through the rest of this, but we're gonna just kind of keep that in mind as we go on here. So 2030, we're going to take and subtract out. Oh, I didn't do the line up here. Hey, no one said anything. No one missed it. Oh, good, he didn't do that. Confusing. All right, so this is 4,752. And this should give us our I had plenty of room on this one. Apparently I don't. All right. So we're going to do this again. Times 40%. We'll be using 0.04. 0.4, I should say. Okay, so this turns out to be 2,851 and 20 cents. Now, one of the things that we do is we round all computations to the nearest dollar. And if you're wondering why we do that, you gotta remember this is horseshoes anyways. I mean, 5-year life, we don't know that exactly. Residual value, we don't know that one exactly. So what we'll often do is just say, okay, just round it to the nearest dollar. So we're going to round that to the nearest dollar. I'll put in this rounded. Okay, so we're going on here. Now this depreciation expense. So this depreciation expense is 2851. Notice if we went to the straight line, it would be divide that by 2, 4,128 would be 2,000 something, 64. So it would be less if we did it. So we don't need this one, but let's put this one in. Okay, and 25. Now this last one will definitely be whatever's left over. And I'll show you that up there. But let's see. So 25,872 plus 2851, 28,723. So this last year, we're going to have to switch over to the straight line method. So we're going to do the same computation. There's only, there's only going to be 1,277 left there for us to depreciate. So that's what we're going to do in our last year. Let me see here. Let me do one more calculation, see what I with. Yeah, I'll show you. I'll show you why we're doing this. Okay. So 2031 look like this. Seven, 1710.8, so 1711, let's say. There's a problem with putting that in. We will go below our residual value, our salvage value. We put that in. If we were to minus out, we would come out with 2,566. That's below our salvage value. This is below the salvage value or residual value. Not value, value. I'm sorry. So this can't happen. This is too much. So we're going to go to this one. This is the last that's left in that account. This will be our depreciation expense in the last year because this is too much. It brings us below our residual value. So here's the straight line over here. What's left in that, what's left of what we can depreciate is this. Ah, yeah. That's this one here. Now 28,723 minus, yeah, don't do that. Come on. Plus 1277 equals 30,000, is what we want it to equal. And this will come out to be 3,000 like we want it to. Okay. So that's that one. Now, you're probably thinking to yourself, well, who in their right mind would do that and why? Believe it or not, this is the way the tax code is set up. So everybody has to do this. Well, the tax code has it a little bit easier to figure out. They do the calcs for you. They don't trust us to do these. But this is the tax code basically. So these are the depreciation expense you'll have every year. You know, it just hit me. I did this wrong. Oh, I did. I did it right. I was thinking if there's no residual value, it comes in earlier. I did it right. All right. The reason I was saying that is that the tax code assumes a zero depreciation, a zero carry value. Anyway, so this is actually done. Now, you'll notice something about these expenses. They start out very high and they get less and less as you go down the page, right? As years go by, it's less and less. And this is sort of to mimic the economic value of what happens with an asset. This is what they call an accelerated depreciation. Is it spelled right? Okay, so this is what they call an accelerated depreciation. It depreciates more in the beginning years and less as time goes on. And it doesn't not necessarily to mimic the market value, but because things are more useful early on. And as time goes on, they become worth less and less. You know, for example, let's take a car. If you buy a new car for whatever, 25,000, you drive it off the lot. At that point, it becomes a used car. You take a big hit on depreciation. It's no longer valued as a new car. Now it's a used car. Okay. And that's just the way it is. Everybody knows that and you accept that when you buy a new car. However, take a car that's 12 years old versus a car that's 13 years old. There's probably not a lot of difference in those two. They're probably pretty close to the same. So we know that, just think about if things are valued at their economic, the true economic worth, that in the beginning you depreciate a lot more. A car that's 1 year old is more, 1 year old is worth more than a car that's 2 years old. As you go on, but as time goes on, it's less and less and less. You get down to 12, 13-year car, it probably doesn't matter too much. So you do oftentimes the usefulness is depreciated more in the early years. So that's what this method is. It's an accelerated method. There's another one in the book that we're not going to do called Sum of the Years Digits. But anyway, this is an accelerated method. The Sum of Your Digits one is hardly ever used. It was taken off the CPA exam for 13 years, and it reappeared twice in the last 12 years now, which means you wouldn't even study it if you're taking the CPA exam. But anyway, so this double declining balance method, this is used by some companies. It's always used for taxes. And that's just because it's the tax code. It does not necessarily mean that it's it's a true value. The tax code is set up to allow a lot of depreciation so that you can write off equipment and things like that earlier. It's a benefit. So anyway, let's go ahead and take a break. Oh, don't end it. You almost ended the meeting. Yay! All right. So we'll do this when we come back. So be back at oops. Yeah. Say 3:11. Uh, we'll do this one. Okay. Um, Units of production. Units of production is used when you don't use the item the same every year. If it's used irregularly from year to year. So, for example, let's say you have a snow plow. You know, some years we get cloud of snow, some years we don't get any. So, you know, it doesn't make sense to depreciate them all the same every year, or even the accelerated, because you're going to use it differently, different amount of, different years. So the wear and tear will be, it could be a very uneven. It could be hardly anything this year, and it could be a lot next year. So that's when units of production comes in. And so it's basically how much do you use it? That's what we're going to try to figure out. And again, if you use it the same every year, just use the straight line method. If you use it the same every year, this is fine. But if you use it irregularly, if they're different from year to year, then a good one to use units of production. And basically, it's the same calculation as we do here, pretty much. I'm going to copy this down, alter it a little bit, because instead of years, we're going to use miles. By the way, this is the last one of these long ones we're going to do. We're going to do it, a couple of years and stuff like that, but not. Okay, let's see here. I'll get rid of all this. Okay, it's basically the same as a straight line, except, excuse me, we're going to use miles as our denominator. So the life is not in years, the life is in miles. Why do I have that color? I don't know. Okay, so anyway, everything will be the same here, except this will be divided by miles. Maybe I'll alter this a little bit, just for the aesthetic value. So we'll get our depreciation per mile. Is that 30 cents? It's 30 cents, right? I don't know. When you're like me, yeah, it's 30 cents per mile. Okay, so this will be, we're going to depreciate 30 cents per mile. Yeah. So what we're going to do, we may as well just do these all at once, I guess. We're going to take 22,000 miles in the first year times and this will give us our depreciation expense. Twenty-two thousand times 30. So this will be our depreciation expense in the first year. Just trying to get more room here. I'm just gonna do the expenses all at once. .4, 72, I mean 7,200. 15,000 is 4,500. 20,000 is 6,000. And you can see they're kind of using it for different amounts every year. The 300. Let me up a little bit here. The mileage I don't think comes out to 100,000, does it? I think it comes out to 102,000. Which for this method is probably okay just to leave it. Oh, I know, I could look and see what the answer is to this. I think anyway. I think I left this one the same. I don't think I changed it. Oh no, they changed it. Okay, that's fine. And you see the problem, yeah, they came up with the same thing I did. So they say revert back to that it can only go down, it can only have 30,000 depreciated. So the last year they say they'll change it to 3. I can tell you that that's not always the case in this method, because sometimes if you use it for more than what you think you're going to use it for, it actually is worth less money. So sometimes I would just leave it, but we'll change it. So this last one is too much. And let's see here. You know what I'm saying? If we thought that we're gonna do it for, I guess 2,000 miles isn't that much extra, but sometimes if you do use it for more than you think you're going to use it, it will be worth less. You won't get as much for it. Okay, so let's see here, and vice versa. So we're going to add up these first 4. And by the way, as long as you're with it, consistent with it, it's fine. All right, so this would be 24,300. So that's why you got the 5,300. You could also just change this. If you change this one to 19, you get the same number. So this will be a plug number of 57. And two, if you don't use all 100,000, if you use like 90,000, this truck might be worth more. Was it van? I think it might be worth more than, the 3,000. Okay, well, we'll use these numbers. I think I'm gonna leave this one as the color being black because it's a plug number. It's okay. It probably doesn't matter. Another thing about depreciation is, I think I told you guys about this before, but there's no cash involved. People in real life, other than for taxes, people don't really care too much about depreciation because it's not there's no cash involved. I take that back. I actually worked for a guy that he used to do the depreciation down to the day, and he'd do it down to the penny. He would make daily reports for some reason. So I guess some people take it very seriously. That 18,300. Hey, I did it. It worked. Okay. I don't do that. Yeah, let's get the carry values in here then. All right, 33,000 minus 66 equals 33 minus, what is that, 27, 26, 400. I'm gonna try doing these just off my head. Won't they be great? You guys can correct me. 13,800 minus 33,000, so that's 19,200. Didn't we see that before? We saw that number before. Did we? No, 19,800. Okay, never mind. Equals 50.
Wouldn't 2027 be 26,400?
Yes, it would. Thank you. Maybe I should be using my calculator. 14,700 for this one. All right, I better use my calculator. The experiment didn't work. All right, minus 18,300. Okay, that one's right. Okay. Minus 6,000. And 8,700 minus 5,700 is going to be 3,000, which is what we want it to be. Okay. And again, this is a plug number. That's why the books, like I say, like in real life, you might just leave it at the higher number because of if this is, if it is tied, if the mileage is tied to the value, it might be that it's, okay, let's see here. I tell you what, let's do this. We'll do these three, but we'll just do the depreciation expense for these three. And then we'll get on to the next one. And I'll let you guys fill in this. So we'll just do the depreciation expense for the years. And then I'll let you guys fill in this. I want to get to make sure that we get to E11.3, and this one won't take long. Okay, so straight line method. Straight line method, we have, hey, the spacing is funny in there. We purchase equipment for 115,000. Estimated service life is 10 years. Let's highlight the things we need. Estimated residual value is 5,000. Oh, they used residual. Yay. And expected to produce 220,000 units. Ooh, that'll come out fine. All right. Straight line method. Take the cost. I'm going to see how I worded it up here. Cost. Okay. Minus residual. 5,000. Oops. Thank you, Word, for correcting that. Back in my day, we had we didn't have the internet, but we had computers, and people were talking about how it would be completely impossible to have a spell check in a word. It's completely impossible to have that. No, it's like this commonplace. Okay, so that's 110,000 divided by 10 years. $11,000 per year. So this will be our depreciation expense for every year, 11,000. And I'll put these in next time when we're in class so you can kind of check them. But this is going to be the per year for the straight line on this one. You guys can fill in the rest of that. Probably be a lot faster too. Okay, so let's see. Nobody claim balance. So this is 10 years. Oops, where am I at? Yeah, 10 years. And that's really all we need to start out this thing. So double declining balance. First, we're going to get the percentage. The percentage equals 1 divided by 10 years. And then we double it. Oh. 0.20 or 20%. You want to check as I go along here just to make sure I'm not doing something stupid. Okay, so first year, 2027. Start out with, and this is where it's a little strange. It's the total cost we start out with. So 115, we do it with the whole amount. %, or point. Whatever that. 23,000. Okay, so this will be the first year. We have depreciation expense. Then we're going to decline the balance. And we'll make that green. Well, and we're going to start it all over again. E2000. And again, we're going to multiply by 20. At 18,400. It is. Make sure I put it incorrectly here. 18,400. And we could check. We're not down. We're nowhere near the straight line amounts. This is to get down to 5,000 and minus 18,000. We're still nowhere near it. So we'll just keep those two. So this will be the depreciation expense for the first 2 years. Should probably put dollar signs in front of those. Do all these. Okay, and you guys can fill in the rest. The cost can be the same, 100 and 115. I'll do the same for all of these. That's the nice one. It just doesn't change. Okay. And units of production. Am I in the wrong one? Oh my God. I'm an idiot. Well, the good thing about me being an idiot is this one's actually easy to fix. Okay. Let me see where I'm at. Round all the nearest dollar. Why I'm so flaky today. I know I'm flaky every day, but today seems especially bad. All right. There we go. I'll fix the other one later. Okay, so Units of production. It's very similar to the one we just did up here, the this one, except that we're going to, instead of dividing by 10 years, we're going to divide by 220,000, where are they? Oh, units? Units. And we'll get the amount per unit. I think it's 50 cents. That looks like 50 cents to me. $0.50. Okay, so this is 50 cents per unit. I want to check my math. I think that's right, though. Hey, that's not me barking, that's my dogs. Okay, so you guys can fill in the rest of those. And it'd probably be more accurate if you did. This is not my math day. Any question on those? Okay, now this is assuming that these were bought on, this equipment was bought on January 1st. The next one we're going to do, which unfortunately I've already started down here. But, well, you know what though? Maybe this is good because this will actually, we have to make an alteration for the first year's depreciation. Okay, so this is, make sure you're on, I don't know why I'm telling you to make sure you're on the right one. Make sure I'm on the right one, but we're going to do 11.3. 11.3 is pretty much exactly the same as this one, except that we didn't buy it on January 1st. We bought it on October 1st. So it should be a dollar sign. Nope. Yep. Life is, everything's exactly the same. You'll notice that this is exactly the same as what we just did. Pretty much anyways. With the exception of, we bought it on October 1st. Okay, so the question is, in the first year, how many months did we have this thing? We bought it on, or whoever it is, Allegheny, bought it on October 1st. How many years did they use this in 2027? Or how many months did they use it in 2027? Anyone? You guys know this. I'm gonna wait. I'm gonna wait this one out. You guys gotta tell me. How many months did they use it for?
Well,
Nope.
120.
Uh, they bought it on October 1st. So in other words, they only had it for how many months of the year? They bought it close. They actually the other side of it. They only had it from October. Let's see, October, November, December.
3.
Yeah. Let's see. Oh, what am I at here? So they had it all of October. They bought it on October 1st. By the way, the cutoff they almost always use is the 15th. If they bought it before the 15th, they count that month. If they bought it after the 15th, they don't count it. And even in like February where it's 28, they just use 15th usually. Okay, so what? I'm sorry, October, November, and December. Oops. So those are the 3 months they had it for, and so we're going to depreciate this for 3 months in 2027. Okay, now this is only going to affect the for 2027, right? I mean, in 2028 we had it the whole, we had it the whole year in 2028, but in 2027 we only had it for 3 months. This is not going to come out to be a nice number, I don't think. Is it? Well, I'll see. Okay, so what we're going to do for 2027, put it up here somewhere, I guess. We had $11,000 per year times what? We had it for 3 of the 12 months, so this will be 3 over 12. Oh, this should come out okay. That's 25%. Okay. Here I was thinking that would be a terrible number. It's not. So multiply by 3, divide by 12, times 3, divide by 12. 2750. Yep, yep. Yep, 3 million. So let's see those. And I lost my spot here. Here it is, 2750. So this will be a depreciation expense in the first year. We only had it for 3 months. Let's go ahead and fill this one in. Just it shouldn't take too long. There's only 2 lines. So 115,000. Oops. 112, 250. Okay, going into the next year, again, we're going to insert shapes. Those two together. 13,750, I think. It was 115 minus 13,750. $101,250. Again, so this is a straight line, but in the first year, now this is only for 3 months. So this is, I'm gonna put this in parentheses. This is for 3 over divided by 12. You know, we didn't have it for much of the year. We only had it for 3 months of the year, so that's why it's low. Okay, double declining balance. This one I have to completely redo. Well, I'll leave this for now. The depreciation expense in the first year is 23,000. What do we have to multiply that by? Because we bought it 3 months into the year. So coming down here, you know,
Is it 25%?
yep. Multiply by 3 divided by 12. Which is some number other than what I have there. $5,750. This is what we're going to decline it by. There's other ways to do that one, by the way, but we're not going to worry about that. So this is minus. This will not be 92,000. This will be something more than 92,000. What about 9,250? And this one will just be a full year. So whatever this comes out is not going to come out to that. Whatever this comes out to will be a, we'll just use that number. So this will be the first year. And again, this is because we bought it with just 3 months left in the year. This one will be a full year, so we don't have to, you could multiply by 12 over 12, but you know, why do that? Oops. 21,850. And obviously this down here is not going to be the same. We have to change this. So this will be the first year will be this. And yeah, you're right, basically a quarter of what it was. Second year is going to be a little higher. And if you think about it, it's because there's still like that lagging year of, you know, 23,000 is still hanging in there. That 23,000 is still included in that balance of, you know, the rest of that 23,000 is still included in here. So that's why it's higher. 27,600. $87,400. Again, yell at me if I get that wrong. Don't yell at me, but you know what I mean. Correct me like you would, like, you know, an old senile guy. Like I am. Wait a minute. I'm gonna do something here. Is that right? 21. Yeah, I think that's right. Okay. We don't have to do that second step there. I mean, there's no way that we would be anywhere close to it. Now, this is where it gets a little bit interesting. Units of production method. Because of production method is not a time-based method. But I want you to show you something, and this wasn't my cleverness. This was whoever wrote the book. His name is Schneiser. I forget his name. But notice that whoever this was, he or she, they made the units of production. Notice that there'll be fewer in 2027 because we had it for less time. If you come up here, you know, in 2027 they made 30,000 in 2027. But notice that if we only have it for 3 months, there's no way we're going to do a whole year's worth of production. So they only did 10,000 in 2027. So this method, you really don't need to do anything with the 3 months because this is basically 3 months worth of production. So the production method kind of solves itself. You don't really, if you're using the production method, you don't really need to worry about if it's 3 months or 5 months or whatever, because the production will be less. And to show you my extreme laziness, you know, so this will be the same, and all we're going to do is multiply it by 5,000. And we'll do the same thing here. This one will be the same. This will be for a full year. This will be the same as the other one. 12,500, I think it was. So this is automatically adjusted that this is only 3 months worth of production. So we don't have to do the 3/12 or anything like that because it's already there. Okay. And we'll fill these in. You know, I think I'll let I'll put the expenses in. How about that? And you guys can do the rest. You probably already have it done. Okay. So kind of fill in the rest of those for these two problems. And we will look at the rest of this here. We will definitely finish this one up before we go on to chapter 10. This one, well, this was a lot of work. We'll see. We'll definitely do this one next class, and then we'll go on to chapter 10 and some of the cleanup stuff in there. This one actually could be in chapter 10, except that they don't tell you how to do the depreciation yet, but they tell you everything else. Okay, so nothing to turn in this week. Can't remember what we have. I thought there was something for the 21st to turn in, but let me look. Oh, the 8-9 exam. The chapter 8-9 handout. Yeah, I think most of you guys have already turned those in. I'll get to those. Okay. Any questions? So hold on to this. So just get the test in the chapter 8 and 9 stuff. If you already got it in, then hey, start your break now. But yeah, no class next week though. So make sure and the only classes we have next week are Monday. That's not it. Our Monday classes. So if you have a Monday class, that will meet. The rest of them will have no class next week.
Thank you, Professor.
Good night. Or good afternoon, I guess. They're gonna let me stop from here. Here we go. Okay. Good night, guys.
Have a good night.